Good evening. My name is Kingsley KK. We will continue on our topic capital allowance. But before we pick up this calculation, let's have a little bit recap of what we discussed the last time. We talked about what a capital allowance is. We defined what a capital allowance is. We also made ourselves understand that the reason of granting capital allowance is the depreciation, which is why it is allowed for income tax purposes. So we're able to explain the types of capital allowance. We have the initial allowance, we have the annual allowance, we have the balancing allowance and the balancing charge. We talk about the investment allowance, we talked about the rural investment allowance. Then we also explained the conditions for granting capital allowance, why are capital allowance granted to assets. Then we also look at the rates and restrictions. We talk about the rate for initial allowance with respect to building, then to research and development. We talk about motor vehicle expenditure. So at least we're going to take this example to explain what a capital allowance computation look like. So looking at the question, they say a company that normally makes up account to June 30th each year acquired asset as follows. You see that this company is a going concern. They have been in perpetuity. It's not a newly commenced business. It's not business that changes accounting date, or it's not business that already ceased. It's a business that have been in continuity. They make up the account every 30th of June. And they acquired assets as follows. On the 31st of December 2011, they acquired building, 5 million. 15th of May 2012, Jeep motor vehicle, 3 million. 30th of July 2012, they acquired machinery for 2 million. And 13th of April, they acquired furniture for 1.5 million. The question is, determine the basis period and compute the capital allowance for relevant years of assessment. Firstly, when given a question like this, the first thing to check is what you're asked to do and how to start doing it. Looking at this question, you see that like I earlier explained, that this is a business, it's not a newly commenced business, so everything you're going to work on this place will be on preceding year basis. And remember, for tax purposes, we work for computation for 3 years. So looking at this question, the first thing they ask to determine the basis period. And how to determine the basis period? The first thing you look at is the year of assessment. Remember, the last asset there is furniture, and this information there is 2014. Looking at furniture, you see that we have 2014 there. Good. Then, for a year of assessment, we are preparing based on preceding year basis. So everything that is in 2014, for we to compute it will be in the year what? 2015. That means 2015 preceding year is what? 2014. So we'll now be having 2015, 2014, and 2013 in our year of assessment. Remember, the business draws up account every 30th of what? June. We are coming in the basis period now. We're coming out in the basis period. So that we're looking at now. They say they prepare account every 30th of what? Of June. So it means that we are going to work on the information given to us that every 30th of June, this company prepare his or her account. And note that the basis period for capital allowance is the same for the assessment of profit of a company. This means that capital allowance are given in an assessment year in respect of the asset acquired, or qualifying capital expenditure in the preceding year of assessment. Let me break it down to where you understand now. Or 2015, we are having 2014. 30th 6 2014, you now count 12 months back. You look at this little calendar I did here. The 2014 is on 6. When you count back, you are having the 1st of July. Looking at that. So on that parameters, you now see that we are having same with 2015, 2014, and 2013. So on this place now, you see that we have drawn up the basis period, in the sense that we are having 12 months. And note, like I explained to you, that the basis period for capital allowance is the same for the assessment of profit of a company. So whatever thing we are having here will also be the same thing for the capital allowance. So looking at this now, we are done with the determination of the basis period. The next thing to go into now is the computation proper. Computation of capital allowance. I want you to look at, we're looking at the first year now. We're looking at the first, I said you should copy down the question. But if you're not coming to the question, then I will go back a bit before I pick it up for everybody to see. So, for the first thing there, you see we have the building, the motor vehicle, that is Jeep motor vehicle, machinery, furniture, and the capital allowance. To that, the last one there is total capital allowance. So, we have the allowances, they are in percentage, the initial and the annual. The one up is the initial, the one down is the annual. So for talking about building, 15% is initial, while 10% is annual. For motor vehicle, 50% is initial, while 25% is annual. So person might be having, how do we get this rate? It's a fixed rate. It's in our last class. If you can pick up your video, you see in the last class where it was listed out there. So the next thing to do now is to start computation. Before we start, let's go back to the question for the last time. If you don't have it, you can get it now. You will see that in the first asset, which is building, it was gotten on the 31st of December 2011. Meaning that in the year of assessment, it will be assessed in the year 2013. Because if you look at that date it was bought, it is falling in between the basis period for capital allowance computation. Like we are having 31/12/2011, but the first in 2013 year of assessment, you see that it falls in between 1st of July 2011 to 30th of June 2012. It's within that period. So definitely the year of computation will be 2013. And if you watch also, for Jeep motor vehicle, the year of assessment is also 2013, in the sense that it also falls in the basis period. So in our computation proper, that's why we see in the year of assessment, you have we are hanging zeros. So that's where we're hanging now. We're hanging 3 zeros, million. That this is 5 million, but we're writing 5,000 now. So for the year of assessment in 2013, we are having building. The building there is 5,000 naira. So that 5,000 naira is the cost of acquisition. And remember, we said and we explained that initial allowance is granted in the year of assessment in the basic period of which a qualifying capital was incurred. And it is granted once. It is granted once in the life of any asset for as long as it is beneficial. So looking at this building and this Jeep motor vehicle, they are beneficial to the company. So the company decides to buy. So definitely we are going to grant them the initial allowance, which is once. Then we are also going to grant them an allowance. So we'll check. We are looking at our attention should be on the year 2013 now. We have seen the cost is 5,000 for building. We have seen the cost of Jeep is 3,000. Then let's look at our workings now. For initial allowance, remember it's 15% that is fixed. So 15% of 5,000 is 750. For motor, then that is 750 down here for initial allowance. Then if you're looking at for motor vehicle, we're having 50% of 3,000, which will give us 1,500. So the 50% is the fixed rate there. We are working out. Let our attention be on 2013. Let's leave down other information. So looking at this now, we have gotten our 750, which is 15% of 5,000. Then 50% of 3,000 is 1,500 on those working here. Then at least we now understood the initial allowance. Then when we're not working for plant and machinery, we're not talking about furniture. That's why we have those dash there. The next thing now is annual allowance. Get the explanation very well here. For annual allowance computation is given as cost minus the figure for initial allowance over N. N talks about the number of years the asset is going to be, or the asset is going to be used before it gets its scrap value. So we're talking about N. Then the issue now is, yes, we know the cost and we know we have gotten the initial allowance. Then how do we get N? We get N by using the percentage 100. The percentage 100 will be divided by the annual allowance rate. Let's take, for example, we are working with building. From the information we have, our annual allowance rate for building is 10%. So it simply means that you're going to say the 10% you're seeing there, 100, we're going to divide 10. When 100 divides 10, we have 10. It simply means that this building is going to stay for how many years? 10 years. Going to stay for 10 years before we granted its scrap value. So it's on that note that we are going to use the amount to charge the particular annual allowance for that particular year. Remember, this is going to stay for 10 years now. In 2013, we are taking for 2013. 2014, we do same. 2015, we do same. Down till the 10th year. So it's on that premise that we are now coming down here. The cost for building is 5,000, which is here. It's in the. Then the 750 is the one calculated in initial allowance. Divide by 10. When you do the computation in your calculator, you have 425 naira. So you come in here and write your 425. Then the next thing to look at now is on the motor vehicle. On the motor vehicle, our annual allowance there is 25%. The same thing that happened in building is what we are going to do here. The cost is 3,000. Then the initial allowance computed already is 1,500. Then the N will now be 100 divided by 25, which will give us 4. So on getting the computation, you'll be having 375 naira. This is what we did here. So we have known how the initial allowance is gotten and how the annual allowance is gotten. So the next thing we look at now is the column, the last column there, which is that and there is total capital allowance. So how do we get this 2250? You add up 750, we're working on the initial allowance now. 750 plus 15, you have 2250. Then for the annual allowance, you have 425 plus 375, you have your 800. So what that simply means that your capital allowance for the year of assessment of 2013 will be 3,050 naira. That is it. Then for we now to say what will be the written down value, that will be the opening balance for the next year, it will now be 5 for building. You have 5,000. You less 750 from it, and you also less 425. You're having 3,825. Then for motor vehicle, you're having 3,000. When you less 15 and 375, you're having 1125. So this 3285 for building, this 1125 for motor vehicle becomes the written down value that will be carried forward to the next year. So looking at year 2013 now, we have ascertained the initial allowance, the annual allowance. So when we total these two, we now have the capital allowance for the year of assessment for 2013. The next thing to do now is look at 2014. We go back to the question a bit so we can get the asset that falls in 2014. Looking at the question, you will see that this asset was gotten from machinery, was gotten on the 30th of July 2012. And looking at our basis period here, 30th of July 2012 falls in 2014 year of assessment based on the basis period. So whatever thing we're working now, we're working for machinery in the year of assessment, which is 2014. So going back to our computation, you will now see that 2014 we have machinery, and the cost for machinery is 2,000. Remember that the initial allowance rate is 50%, the annual allowance rate is 25%. This is fixed. So going to our workings for 2014, our initial allowance will be 50% of 2,000, which will be 1,000. Are you getting? Are we together? Please, if there's any question so far, you can drop it in the box, please, so I can respond immediately, so we can move on. So any question you can ask, any question you ask, just draw my attention. I will respond very well. So 50% of 2,000 is 1,000. That is this 1,000 initial allowance. Remember, now we are on the 2014 assessment year now that we're working on. 2013 is gone. If there's any question, drop it in the box. Then for the initial allowance is 1,000, which is the 50% of it. Then to get our annual allowance, we have explained that is the cost minus initial allowance over N, which N is the number of years, and we have explained how we get N. That N means 100 divided by the annual allowance rate. The annual allowance rate for machinery is 25. So when you say 100 divided by 25, you're going to have 4 years. That simply means that this asset is going to be used in this company for 4 years. After 4 years, it will bring up its scrap value. So you get your annual allowance will now be 2,000 minus 1,000. Then whatever thing you get there, you get 2,000 minus 1,000, you have 1,000. 1,000 divided by 4, you have 250. So 250 becomes the annual allowance you charge that you are going to give them for every year. So that's why when you come down here, you have 250 here. Then looking at the annual allowance rate, which I'll be explaining so far, you now see that for building, for 2013 we have 425. Then for 2014 we have another 425. Are you seeing it now? Then for motor vehicle, on the 2013 we have 375. Then because the asset is used in the 2014, we are having also 375 also. So are you seeing it now, right? So when you talk about for us to get our total allowance for 2014, we will now say the initial allowance is 1,000. Then the annual allowance will now be 425 plus 375 plus 250 to give us 1,050. So on that note, when you total these two on the capital allowance column, you are having 2,050 naira. Then for we to get our written down value for the next year, it will now be, for building, you're having 3,825 minus 425, you're having 3,400. Then for motor vehicle, you're having 1,125 minus 375, you're having 750. Then for our machinery for the year, you're having 2,000 minus the initial allowance of 1,000 minus the annual allowance of 250, you're having 750. So this becomes your tax written down value that will be carried forward in the next year. Then, in the question, the last asset we have there is furniture, which costs 1.5 million. And looking at the date it was acquired on the 13th of April 2014. Looking at the year of assessment, it falls in the 2015 year of assessment. So that's why when you come to the computation, you're working now for the last year, 2015. At least so far so good. We are following the computation. So 2015 is just something we did in 2013 and 2014. Then in 2015, the first to look at there is the assets that was acquired first, which is furniture. We're having 1,005 hanging our zeros up. The furniture, the initial allowance is 25, the annual allowance is 20. So we'll go to our computation, our workings. So 2015, see, initial allowance, they are having furniture. 25% of 15 will give us 375. That is 375 gotten here, which is the initial allowance, 375. Then for the annual allowance, the same thing we have been doing since. The cost, which is 15, minus the initial allowance, which is 375, divided by the number of years. How do we get number of years now? 100% divided by 20% of the what? Annual allowance rate. Look at where we got 20% here. 20% is gotten from here. So when we divide, we are having 5. So 15 minus 375 divided by 5 will give us 225. So we'll come in here, we'll bring in our 225. Remember, we saw our building is going to stay for how many years? 10 years. So we still have it down. Our motor vehicle is going to stay for how many years? 4 years. Our plant and machinery is going to stay for how many years? 4 years. So we'll still bring them down here because they haven't elapsed. The allowance have not elapsed. So we'll bring them down here. So we'll see for building we have 425. We'll see for motor vehicle we are having 375. We'll see what machinery we are having 250. So we look up. For you to get our last written down value carried forward for the next year, if we are to compute for it, if the information compute for it, you now see that you're having 34 minus 425. You're having 2975. Then 750 minus 375. You're having 375. Then 750 minus 250, you're having 500. Then 15 minus 375 minus 225, you're having 900. This figure down here is now the written down value that is to be carried forward. Then for you to get the capital allowance for 2015 will now be 375 plus 1275, you have 1650. Let me explain a bit to what we mean by saying an asset stays a number of a useful years. Look up. Let's look for motor vehicle now. Motor vehicle was gotten in 2014, and we say it's going to stay for how many years? 4 years. So it means they're going to say what? 2013, 2014, 2015, and what? 2016. That makes it 4 years, right? I look up. For the annual allowance, they have taken away 375. We're talking about for the first year, which is 2013. 375 is up. For the second year, which is 2014, we're taking again 375. That is the second year. Look up. If you see now, on the third year, which is 2015, we're taking out what? 375. What's the amount left? 375. Simply means that this 375 is for the fourth year. That means on the fourth year, you get the scrap value for the particular asset. So that's what we mean by the number of years an asset will stay. So if we are computing for building now, this particular building that was bought 5 million. If we decide to be granting annual allowance, remember we're still going to stay for how many years? 10 years based on our computation here. 10 years. There isn't 10 on building. So this, if you start granting 425 every year from 2013 to the next 10 years, you can do that on your own. You see on that 10th year, you are going to have 0 as your balance. So that simply means that a particular asset stays the number of useful years. So looking at the workings and our computation, if you have any question to ask, you can drop it in the box. I will respond to you. If it's on the workings or on the question so far. And note, remember that there is an incentive granted where a company has acquired expenditure on plant and equipment. Remember, we acquired plant and equipment, which is a plant and machinery too. And when such case is being done, that is being granted an investment allowance of 10%. That's the last computation we did here. But remember, note, like I told you there, I said such allowance are not to be taken into account in ascertaining the tax written down value of a qualifying capital expenditure. You can just do the working there to get your mark, but it does not come into the computation at all. Just come on the workings part, they just show them, because an investment allowance is on plant and what? Machinery. So that's why this computation is done here. So far so good. If there's any question you want to ask, drop in the box. In our next class, we'll look at a question that concerns on Jampaki with solutions. So go through this, pick up questions that have similar questions, solve it, and when you have challenges, you can drop in our WhatsApp box. I will respond to you. But in our next class, we'll be looking at a more complex question, where you now a more complex question. Look at the more complex question. We're talking about overlapping basis period. So then we will now look at commencement. We look at cessation. We look at when the business is changing accounting year. So that's where we see a very question. But we should know the preamble before we start. So look at the solution very well. Look at the workings. Anyway, anything you know that you feel you can ask questions, you let me know. Thanks very much for your time. I appreciate it. Bye.